One Step Ahead by Lundquist and Beslick.
Good morning and welcome to One Step Ahead Radio.
Firms in the US and I guess in many European countries doing is that they are buying assets from fossil fuel companies, taking them private and then running them as they used to run them. And this is something interesting from a perspective of what the research produced in the US has come to a conclusion. We'll go through that as well. Psychedelics to tackle climate anxiety. This and a couple of other very interesting sessions during the Climate Week in the US. We'll go through that and what they actually want. The US dams or the infrastructure that is used in the US, especially in relation to this new hurricane that passed through parts of the US, are not holding up. And McKinsey is saying also that we have technology that we need to use and we don't need to have new technology to tackle climate change because most of the technology, if we scale it up today, would lead to 90% of reduction of CO2 emissions. And some other smaller news like Suriname that is issuing the first UN-backed sovereign carbon credit, which is interesting from a perspective of how countries are doing this. Now, if we dive into what is going on in the terms of the private equity sector, and this is a quite sort of you have to bear this one in mind when we talk later on after this about the US dams and the hurricanes that are hitting the parts of the US. Now, the US public sector's worker retirement savings are basically invested in a project that pump out 1 billion tons of emissions a year. Private equity firms are using the US public sector workers' retirement savings to fund fossil fuel projects, pumping more than 1 billion tons of green gas emissions into the atmosphere every year, according to analysis that has been done. They have basically invested more than $1 trillion into the energy sector since 2010. Often they're buying into the old and new fossil fuel projects, and thanks to exemption from many financial disclosures, which are, of course, on the listed side completely different, they are operating these assets outside the public eye, and this is in many cases fact, because they're using the funds from these workers that are also severely affected by climate change consequences in many states. They are basically mortgaging the futures of these people by taking the money and putting them away for old age, and they're investing this in the assets that risk serious damage to the climate, but also serious damage to their savings and also returns, taking into account that many of these assets allegedly, as somebody said to me, could be stranded assets going forward. Researchers at the Americans for Financial Reform Education Fund, which is the Global Energy Monitoring Private Equity Stakeholder Project, assessed the holdings of 25 private equity firms, overseeing a combined $6 trillion in assets under management. Together, the analysis found that 21 firms were funding projects responsible for releasing more than 1.17 billion tons of CO2 equivalent a year. The research compiled from financial data services company website, press releases, and news reports was limited to 3 categories of investments: upstream, fossil gas terminals, and coal plants. And so does not represent firms' entire emission footprint from energy investments, but only what they actually invest in. They basically ranked many of the private equity firms to see exactly how much, and one of the EIG is ranked the first and has received the F grade. It has 23 fossil fuel companies in the portfolio, the majority in the upstream operations, giving it estimated upstream emission of more than 255 million metric tons, the most among the peers. Now, when you listen to this, you should also bear in mind that we do have a public retirement funds in Europe, and that European public retirement funds are also invested in what is called alternative asset classes, private investments, private equity-driven investments, or investments that are directly invested in companies and projects that may have adverse negative impact on environment, but also increase the emissions. So you have this very interesting story where the parents are saving money for their children, children to go to university. They are recycling. They're doing all these positive things. They're buying organic if they can afford to do so, electrical vehicle and so on. And at the same time, the pension savings schemes are invested in the companies that are increasing fossil fuel production and increasing these emissions. It is, however, the fact. Now, if you bear this in mind when we go into another topic, which is related to the flooding that has hammered Appalachia in the U.S. in the aftermath of Hurricane Helene. Why do they call it Helene? Why it's always a female name? Why not Donald? Donald will be probably a much better name in this context. So residents have become very intimately familiar basically with the new norm in the U.S. post-storm script. Dams at imminent risk of failing. And looking at the statistics in some of these things, the average U.S. dam is 60 years old, according to the American Society of Civil Engineers. Even though dams typically are designed to and built for about 50 years, there are more than 92,000 dams nationwide in the U.S., according to U.S. Army Corps of Engineers inventory. Of those, 16,000 or close to 20% are classified as having a high hazard potential. That does not mean they are increased risk of failure, but that the failure would entail a significant loss of life or property. This group includes 98-year-old Lake Lure hydroelectric dam. The number of high hazard potential dams in the U.S. has risen as development enroaches once rural areas. Now, over the past decade, extreme precipitation, the rain has caused partially complete dam failures in Connecticut, Minnesota, and Michigan. In 2017, heavy rainfall brought California Oroville Dam to crisis stage and forced the evacuation of more than 180,000 people. This is very interesting information compared to the one that I just told you about the private equity firms in the U.S. using the money from the same people affected by these failures of these dams to invest in more production of fossil fuels and coal, not only in the U.S., but also in other parts of the world. Now, there are solutions, and what are these solutions? And solutions are available. According to McKinsey, they basically say that many of the technologies needed for decarbonization, the primary sources of planet warming gases already exist. They just need to be scaled. Many of the technologies needed to decarbonize, they need to be scaled and roll out at the size. According to McKinsey and Company, if carbon capture, heat pumps, and like were deployed at scale, that could reduce as much as 90% of the global green gas emissions. Now, that sounds very good, but 90% of these reduction in emissions can be delivered by 12 categories of climate technologies. However, just 10% of those are commercially competitive, and a further 45 are commercially available, but require further cost reduction to become competitive with the carbon-intensive incumbent technologies. The remainder hold great promise, but they are in early stages of development, according to this consulting group. Now, this is very interesting, and it sort of points us at something that I mentioned initially, which is related to postponed EU regulation. So, EU has decided to moves to delay, basically, anti-deforestation rules. And what are these rules? So the proposal that these rules were sort of drafted over the last couple of years, and Brussels intends to postpone a controversial anti-deforestation law for a year in response to growing concerns from trading partners, the European Commission has said. Given feedback received from international partners, that will be the big countries that we are importing stuff from, US, India, Brazil, and Indonesia, and many others. It basically says there's a concern that this will be seen as protectionism, and that the prices for the goods in Europe will increase, that the fact will have a significant impact on the livelihoods and the cost of living for people in European Union. Now, this proposal must be approved by European Parliament and the member states before the law as such is supposed to come in force December 30th. Now that has been postponed. It will be implemented 12 months later. The law, which is intended to stop European consumers contributing to deforestation, stipulates that commodities including coffee, cocoa, rubber, wood, and palm oil cannot enter the EU bloc, if they are grown in deforested areas. You can imagine the amount of money that many of the companies, mind-blowing amount of money that many of the companies outside the European Union will use if this is something that will be implemented in the force and in the way how many of the NGOs would expect this to happen. However, the countries will be classified depending on the risk. And the classification will be done in a high, medium, or low risk, which dedicates how heavily the export will be politicized by European Union. And according to one person or commission representative, a large majority of countries worldwide will be classified as low risk. Many producing countries, including Thailand, Vietnam, and Brazil, have already put in place measures they hope will comply with the rules, and some companies have urged swift implementation. This is apparently not the case because Ursula von der Leyen has been lobbied by a number of organizations, and basically 27 European business associations representing farmers, magazine publishers, and manufacturers call for delay of this implementation, echoing demands by several countries, including Germany. James, I know you're there, and I know that I asked you to have some ideas and thoughts what this sort of signals in European Union, because one of the things that comes to my mind is that if we are delaying some of these proposals that are firmly far away in their sort of a development and implementation, what will happen to the European goals, to reach certain targets 2030? What's your take on it?
Yeah, good morning, Sasha. Thanks for the introduction. I think it's always important in these cases to kind of see beyond the very short term and the immediate kind of reactions, because I think what we've heard this week is a lot, focused. It becomes very polemicized. Everything becomes very black and white, right? And it's either terrible backpedaling and sacrificing, sort of consumer protectionism and the green agenda and caving in to these interests, or on the other hand, it's sensible rethinking of the practical and pragmatic approach that's kind of starting to be introduced in Europe. And I think looking further beyond, as many companies will be doing, into the medium term, you've got to think that this is the way business is going to be done. These kind of protections, these kind of rules are going to be implemented more and more widely. Obviously, the EU's always tried to be a bit of a climate leader over many years, and this is kind of a bit of payback time, because it's one thing to lead, it's another thing to take everybody else with you on an issue that's like, the more you read about it, it's just vastly complicated.
It is.
It touches things about transparency and privacy, or privacy of data, satellite data, how you monitor these. There's a whole raft of different things. And I think for business, it's like 1 year of delay isn't actually that much, but it's 1 year of opportunity.
Exactly.
To think about how you respond to this changing environment, to these kind of things that we can call it's compliance, right? But think about not just whether or how. It's more about how, and how you're going to adapt and prepare your business, your supply chain, but also your business model and the way you present yourselves and what you're doing as a business in terms of sustainability to your clients, to your customers, to your employees.
So this is one of the,
this is going to be interesting. So
thanks, James. This is one. No worries. This is one of the things that I've been looking at for the last, I don't know, couple of years, and I'm looking at it on a daily basis on the investment side, is the lack of this clear value proposition that companies need to have. Right. Why should I actually invest in them? Not because they have leading products or they are tapping into certain market segment. What is the sustainability value prop they have? And still, despite this has been going on for so many years, still CSRD, we have all of these things. We lack the sustainable value proposition from the companies. And this is something we will address this in One Step Ahead Radio going forward and focus a bit more on that to see actually what is it and how does it work. I think this is also the time for many companies to shift gears and try to move move this much, much closer to the business operation than just simple conduct. Thanks, James. The last thing, yeah, please.
To say, I know is what you were just about to say is that we now have all the recordings. You know, we've done. We managed to put online all the recordings of our previous conversations that we've had, and forward-coming ones will also be available on our website, which is lundquist.it. And if you search, you've got One Step Ahead Radio. We've got an archive that's going to be enriched every week with all of our thoughts and all of your reflections. So that's something that's very good and positive, that people can find a place to go back and listen again and connect all the dots in all of your thoughts and everything we've been discussing. So that's something that we're very happy to have online now.
Thanks, James. Thanks a lot. And that will be all for this week. Thank you very much for joining One Step Ahead Radio. And please share this with your friends, family, colleagues, people you think should listen to this. And I wish you all a great weekend, and we'll talk again next week. All the best.
Goodbye.